From New York to our Bloomberg television and radio audiences worldwide, this is Balance of Power, where the world of politics meets the world of business. I'm David Weston. We're going to start again today with the markets, and we're going to turn to Abigail Doolittle. Abigail, I'll be frank, I'm stealing your word, a bit choppy, I think, this week.
Oh, you're right about that. That is a favorite phrase this year because we have had quite a bit of chop, if not outright volatility. But chop today really does describe it because at the highs on the open, the S&P 500 up about 0.8% at the lows, down 0.4%, and then everywhere in between. And that's pretty consistent with what we've been seeing on the week. Some big volatility or some decent intraday volatility. Typically that will translate to closing volatility. So it'll be interesting to see if there's bigger moves on the close in the days ahead. As for today, what's holding up the markets? Technology. That's why we have some big outperformance for the tech-heavy NASDAQ. On the other hand, you have some of the smaller cap companies trading lower. And then one pressure, David, could be crude oil, the commodity complex coming under pressure after a big rally for a couple of days. That part of the risk asset trade falling. So again, pressuring stocks just a little bit overall, or that risk appetite.
Yeah, the oil clearly is important, as it has been for weeks now. Abigail, talk to us also about U.S. Treasuries, because now we're going to have to borrow an awful lot of money, and it's putting the Treasuries under some pressure as well.
You are right about that, David, and that's a point that I really would like to highlight because something interesting is happening not just today, but over the last 2 days. So, of course, earlier today, the announcement came out that Treasury is going to be a lot of issuance at the long end of the curve. So that means those longer-term bonds are selling off. The 2-year yield, or the 2-year bond, though, is rallying, which means its yield is going down. As a result, you have this steepening for the yield curve, which is healthy. There are some saying that maybe this issuance toward the long end is for the goal to steepen the yield curve, normalize it, so to speak. One concern, though, that steepening yield curve could be creating some of that chop that we're seeing for stocks. That sometimes can happen when you start to see the yield curve trade higher out of some sort of a low. Even some say that a steepening yield curve has after an inversion, and of course last year we did have a brief inversion, can signal a market top. It's unclear whether or not that has happened in the case, or it could happen. But again, that could be one pressure there as there is more issuance at the long end of the curve. And I believe, David, they're even bringing back the 20-year bond. Some people are surprised by that. But yes, we're going to have to pay for everything that we're doing to help around this crisis. And that is how we're doing it, debt.
Yeah, partly with the 20-year bond. Okay, thank you so much to Abigail Doolittle for that report on the markets. Well, a lot of the market movement has been in anticipation of the possibility of reopening the economy, something that President Trump talked about specifically when he visited Arizona yesterday. We welcome now a member of the Arizona congressional delegation. He is Congressman Raul Grijalva. So, Congressman, thank you so much for being with us today. We always like to start with what is going on with the coronavirus in the state of Arizona. Give us an update.
Well, we had yesterday we had the most fatalities that we've had since the onset of the pandemic, and the cry in Arizona continues to be from health providers to the public in general. More testing, both for the virus and for antibodies, and that continues to be a problem, because I think the sampling that some decisions are being made at the state level here in terms of opening it, and also by the Trump administration, are based on not the quantity of information that I think we would need to feel more secure. Arizona is particularly hit hard in Indian country. We have 22 federally recognized tribes, and the pattern that we see across the nation in that lower income, poor communities, great extent communities of color throughout the state, and rural Arizona continues to be shortchanged in terms of the response, number one, from the relief, and number two, from the attention that I think is necessary in terms of making sure that these communities are receiving resources. But more importantly, we don't do it at our own peril. Making sure that if we're talking about limiting the spread, identifying hotspots, being able to intervene quickly with medical support and with testing and other resources, then we have to know where everybody is at in terms of this virus, and you can only do that by testing. So I think Arizona, like every other community across this country, what defines this discussion about reopening is uncertainty. Uncertainty as to the information that we're basing this on, uncertainty as to the Trump administration. Now the phasing out of the White House task force, coronavirus task force, and the phasing in of his son-in-law to begin to take the lead on America's response, focusing on the economics of it and not focusing on the health side of it. They're intertwined together, and I think part of the
I think the president
uncertainty part of the uncertainty is the consumer itself. How certain are we going to be that once businesses are open, that they're going to respond in the way that people want them to respond? I think there's a great deal of health uncertainty and security issues on the part of many Arizonans.
No question about that. I think President Trump actually tried to clarify on his coronavirus task force, saying he's not going to shut it down. Maybe he's going to change it into something else. But one of the issues is the economy and getting people back to work so they can support themselves. And then there's a difficult trade-off. I know you've been concerned specifically in the area of fruits and vegetables involved in Arizona. Tell us about your concern about the inspections and how close people have to be.
Well, all we were asking of that is not to compromise food safety at all, but to expedite the movement of the products at the border. And with the new, more stringent guidelines, what was happening is that it was backing up. It wasn't getting done. And the threat of perishing food that was being imported from Mexico primarily was not moving. And all we said was let's waive the new requirements until this pandemic dies down. It's essential to those border communities. 22% of the workforce is involved in the produce exchange and import-export, and it means a great deal to the local economy. But beyond that, that is starts to become our winter products that are coming through those borders, and the cost to the consumer is going to go high because the imported vegetables and produce is not coming through. And, the essential workers right now, it's ironic, are being considered the farm workers because if those crops do not get picked, if they do not get set, and this is in the United States, in Yuma County in Arizona, which is huge for winter produce, and in other parts of Arizona, then there is no movement nationwide, and the food chain, again, is more compromised, and the consumer's paying a lot more.
So, Congressman, one question, of course, is how we get and when we get the economy back running again. Another is how we support the economy, and particularly the workers. In the meantime, we've had a fair amount of money appropriated out of Washington already. Has that helped Arizona? And perhaps more timely right now, we have Speaker Pelosi saying today she wants another bill, but she wants it to originate in the House of Representatives, where you serve, rather than someplace else, to really come up with the best approach to help state and local government. What is the problem in Arizona with state and local government?
I think that the next bill has to be more prescriptive as to how we want the money used and how the administration implements it, and the guidelines. I think part of the problem in terms of the utility of the packages that we've had, and yes, they've been a necessary intervention. They've helped people economically, individuals that were no longer working. We have 500,000 people that have applied for unemployment in the state of Arizona alone, and 30+ million nationwide. And so, of course, that has been a necessary relief intervention economically. How we go forward, though, I think that for some workers that are frontline, that have no choice, the people that pick up my garbage, the grocery folk, the people on the front lines on the health side, and first responders, and the list goes on, and farm workers, I think part of what we're talking about is premium pay. They're taking a hazard. And as such, at the very minimum, we should compensate them with some level of increase to their salaries hourly, so that they're able to protect themselves better, and to also, as essential workers, be recognized for the work that they're doing, that they have to do. They don't have a choice.
Okay, thank you so much, Congressman. Really appreciate you being with us today. That's Congressman Raul Grijalva, from the state of Arizona. Coming up next, we knew it was going to be bad for Disney. Yesterday we found out just how bad. We're going to be joined by Laura Martin. She is from Needham on exactly the Disney earnings and where they're going next. This is Balance of Power on Bloomberg Television and on radio. Welcome back to Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for Bloomberg First Word News. For that, we go to Mark Crumpton.
David, thank you. President Trump now says the coronavirus task force is not dismantling, it is just refocusing. On Twitter today, the president praised the task force and said it would continue indefinitely due to its success. This comes less than a day after Vice President Pence signaled the task force would be disbanded. The president said today the task force will shift its focus to concentrate more on rebooting the U.S. economy. Secretary of State Mike Pompeo is again ratcheting up criticism of China's handling of the coronavirus pandemic. At a briefing today, the Secretary of State accused China of covering up the origins of the virus. At the same time, he eased off earlier claims of, quote, enormous evidence that the virus escaped from a laboratory there. In the UK, officials are likely to begin easing the coronavirus lockdown on Monday. Prime Minister Boris Johnson says he will unveil specifics on Sunday. The Prime Minister also set a new target of 200,000 virus tests per day by May 31st. The Prime Minister is under pressure to get the UK economy moving again amid criticism that he was slow to react to the crisis. The UK has more than 200,000 cases and more than 30,000 deaths. That's the highest virus death toll in Europe. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much to Mark Crumpton. Well, Walt Disney Company gave its earnings out after the bell yesterday. We knew it was going to be rough. I'm not sure we knew just how rough it was going to be. But Laura Martin from Needham Company is here. She's a senior entertainment analyst with Needham. So, Laura, what stood out for you? As you've said in your note, they have very strong assets, but what good are strong assets when you've got an economy that's dead?
Yeah, I think this is the company that's had the worst luck with COVID. Basically, 100% of its revenue is impacted one way or the other by COVID, and about 75% is negatively impacted and actually just closed for business. So you have cinemas closed, which hurts their film business. You have live sports closed, which hurts ESPN, and you have parks closed, which hurts about 35% of EBITDA pre-COVID-19, like last fiscal year. So they are saying, what they said was that they have cut the dividends, which saves them $1.6 billion of cash. They've cut executive salaries. They've laid off 120,000, furloughed 120,000 people, and that should lower the park closures for the last 2 weeks of last quarter cost them $1 billion in lower EBITDA. So some of these cost savings will mitigate that downdraft in the current quarter that we're in, and they're going to start opening May Shanghai at about 25% of capacity on May 11th. So we'll see how that goes, and if they can figure out a way to deal with park reopenings, that should be helpful for the stock over the next 6 months.
Is there any projection of when they might reopen, for example, Disney World down in Florida, which is awfully important for them, as you know?
Yeah, so what they said about that in terms of park phasing is they'll do China first, and they'll see how that goes. They are bound by the local regulations in the U.S., the states. So while the park here in L.A. has a lot more drive time traffic and therefore would be easier to open because no one has to get on a plane in terms of attendance rebound, California may stay locked down longer than Florida. Florida, normally, has about 70% of visitation coming from planes and 30% from locals. But those locals, if they're going to limit park attendance to 30% of capacity anyway to retain social distancing, then maybe they'll open Florida, I think, will allow them to open the Florida park probably in the second half of this calendar year, I would guess.
Laura, as you know well, there are sort of two questions here. One is, how long will it take to sort of get things back running again? And do we have the money to get through it? They have a fortress balance sheet. They got a remarkable balance sheet. That won't be a problem, presumably. But there's a second question as well. Over the longer haul, the next 2, 3, 4, 5 years, can we expect the same kind of top line for Walt Disney Company as we've had for the last few years? And if not, does that change the valuation of the company?
Well, the stock is down from like 140 to 100, so the stock's down 40%. So I think the right question, or the good question that we ask ourselves is, at what point is Disney cheap enough? Because even if it takes the parks 3 years to get back to pre-COVID levels and the cruise ships 5 years to get back to pre-COVID levels, it feels like cinemas and live sports will be back to more normalized within a year. It feels like the returns on invested capital are injured in the 1, 2, or 3 year frame, but these still are the preeminent assets in the world in their space. It's not like some other theme park is taking share from Disney while Disney's dark. So at the end of the day, 4 years from now, we still have the best assets in class, and the ROIC should get back. So really the downdraft in valuation is, what is the present value of the cash flow streams we don't get back because of the passage of time? And I wonder if a 40% downdraft is getting there.
So Laura, goodness knows, anyone who knows this company certainly knows the value of those assets. I worked there and I saw how they worked internally. They're remarkable. At the same time, have we seen the bottom yet? Because let me bring up one specific thing, college football. College football is terribly important to ESPN. There's already some pressure on ESPN with some people saying we're paying too much for it. We don't have live sports. If there's no college football season, which is a possibility this year, what's that going to do to Disney?
Yeah, I think there's a lot of pressure from politicians for Comcast and Altice to give money back to consumers because they're not getting live sports, and they're paying about $20 a month in the bundle for live sports. And then that comes back to ESPN, and ESPN's sort of the primary sports driver. So I take your point that, look, the professional leagues really want sports to come back because a lot of this economic cost is going to be on them because they still have to pay their players in large part. So the professional leagues are going to be under more pressure to come back, and then they will lead the way for college. My gut feel is that college will take longer because putting students in harm's way for no economic profit to them, just for the institution, feels like a less socially acceptable lives versus money trade-off. But the pros really do want to get back to work because this is their livelihood. So I think we'll see a rebound, or I think, go ahead.
No, I just didn't want to leave you without talking about streaming. We have to talk about Disney Plus and ESPN Plus and things like that.
Sure.
They're shooting the lights out on Disney Plus, for example. It's $54 million. At the same time, they're losing money on it. When is that going to turn around?
Yeah, they lost 420 more million, and they're up to 54 million. They're opening a lot of new markets, so I expect that too. They're saying 2024. So this is a huge asset the way Netflix is, where it loses money, but it's gaining subs. They basically did in 5 months what it took Netflix 12 years to do in terms of sub growth. So, and they're going to open new markets. So, I think this is going to be the Netflix killer. Disney Plus will be the Netflix killer, but that doesn't mean it's going to make money or help them with profitability in 2021 or 2022.
Yeah, it would take an awful lot to make up for those theme parks and cruise ships and movies and things like that. Thank you so much, Laura. It's really great to have you with us. That is Laura Martin. She is Needham Company's Senior Analyst for Entertainment. Coming up here, we're going to have Stock of the Hour. Bunge is dropping off because it turns out that restaurants use vegetable oils, but we don't when we cook at home. That's coming up next on Stock of the Hour on Balance of Power on Bloomberg Television and on radio. Welcome back to Balance of Power on Bloomberg Television and Radio. I'm David Weston. We have breaking news as we come back here. Spain's parliament now has voted to extend the lockdown and the emergency to May 23. As we know, Spain was hit terribly hard after Italy, started to come back. At the same time, it appears they think they need to have that state of emergency extended to May 23rd. There's a larger issue, of course, in the European Union, which is the different effect of the coronavirus on different countries and the different responses and the pressure it's putting on the European Union as a whole, as they're still struggling to come up with a common approach to fiscal stimulus. So that's the latest news. Spain is going to extend its state of emergency until May 23. And right here we have Stock of the Hour. It is Bunge, and its shares are falling as it says it's not going to make the earnings that it thought it was going to in 2020. And for the full report, we have now Abigail Doolittle. So I think it has to do with vegetable oil, if I'm not mistaken. Abigail.
That is certainly a big piece of it. So those shares of Bunge really tumbling on the day. In fact, the worst day in this rebound rally. So that's significant. They're having their worst day since the middle of March when there was that tremendous selling pressure. And it has to do with the fact that they put up a surprise loss. They also missed revenues in a big way. And the reason being that vegetable oil that you're talking about. Now, relative to this company and what they do, they, of course, are one of the world's largest grains traders, the global agribusiness and food company. They buy and sell grains, but they also make oil seeds for protein meal for animals. But another piece of it, beyond the sugar and ethanol oils that are used by the restaurants, and with restaurants closed, all the vegetable oils that are typically used in that restaurant production not being used. So that is really being talked about relative to the big miss, and also a lack of visibility into the second half of the year, similar to so many other companies that have been reporting in April and this month of May, David.
Yeah, it's fascinating. I didn't realize that we don't use as much vegetable oil at home as restaurants do, as a practical matter. But was the situation made worse, and it's no through fault of theirs, it was bad luck? They made a big investment, didn't they, in vegetable oil a couple of years ago?
They did. They made an acquisition back in 2018. I think it was the last big acquisition of the last CEO. I don't know that you could say it was necessarily a bad investment at that time. Very difficult to predict that this sort of situation, this crisis that we're in now, where restaurants are closed, is happening. You know, something that's interesting, David, is they're talking about not seeing any sort of major disruption to the food supply chain. And that, of course, is interesting only because their numbers have been affected. They've also cut back relative to that protein meal for animals by 10%. But earlier this week, we're talking about Tyson. They're having major problems because, of course, the proximity of their workers. They've been forced to close plants. So the shares of Tyson and Bunge, even though Bunge's saying that they're not seeing the disruption, despite, again, cutting numbers, those shares on the year or over the last 6 months or so down sharply. But what we do have trading higher, and they reported yesterday after the close, Beyond Meat, the faux meat company, really doing quite well, revenues beating in a big way. And it looks like even though restaurants are closed, they've seen a huge surge in retail, maybe because of some of the meat shortage, but also the sense that that faux meat is perhaps cleaner, for a lack of a better way to put it. So that could be one positive to come out of this crisis, more use around these faux meat products, David.
There you have it. Thank you so much to Abigail Doolittle for that report on Bunge. Coming up here, we're going to talk more about the U.S. economy, as the Treasury says it has to borrow more money, and the president of the St. Louis Fed, Jim Bullard, says we can't keep the economy shut down forever, or we may face a real depression. That's coming up on Balance of Power on Bloomberg Television and on radio. Welcome back to Balance of Power on Bloomberg Television and Radio. I'm David Weston. It is time now for Bloomberg First Word News, and for that we go to Mark Crumpton.
David, thank you. New York City's average unemployment rate may triple to 12% this year, higher than the Great Recession. City Controller Scott Stringer is predicting job losses will spike by the end of June, with more than 900,000 people losing their jobs. Stringer's forecast, outlined in a report on Mayor Bill de Blasio's budget proposal, is more dire than what the mayor predicted just last month. Germany is taking its biggest step yet in relaxing curbs to contain the coronavirus. The country is preparing to open restaurants and all shops, as well as restart professional soccer games. But limits on public contact will remain for weeks or months to come, and restrictions may be reinstated if a hotspot emerges. Chancellor Angela Merkel urged Germans to stick to social distancing rules to stem the risk of a second wave of coronavirus infections. The Paris public transport system will deploy as many as 2,000 police officers to enforce rules on social distancing and the wearing of masks when France starts to ease lockdown measures on May 11th. The transit operator in the French capital has also increased its cleaning budget by at least 70%. The biggest unknown for the commuter network, which is among the busiest in Europe, is just how many people will come out next week when schools, workplaces, and stores start to reopen. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. Well, businesses right across the country are dealing with very tough economic circumstances. We got to talk with one of them. He's the Cisco CEO. He spoke exclusively to my colleague Alex Steele. He is Kevin Hurricane, and this is how Cisco is coping with the situation.
The first thing we needed to do was to ensure liquidity of the company, and we've succeeded in that regard for sure with the $6 billion of cash and liquidity that I described. Second is we needed to take dramatic expense out of the business, reducing our variable expenses to match the outbound customer demand. We communicated yesterday we've taken $500 million of cost out of our expenses in just Q4 alone. We're on a July 1 through June 30 financial calendar. And then the third is maximize business opportunities in the near term, which I spoke to on those retail opportunities. Fourth is what does the future look like? How do we prepare for a new business environment and climate? And how do we succeed in that climate? And we are actually accelerating strategic initiatives to enable us to succeed in that environment. Directly tied to your question, as I mentioned earlier, we do anticipate schools will go back to school. That's a big business for us. Restaurants will recover. The speed with which they recover is to be determined. We're prepared for it to take a long time. We hope that it happens earlier and faster than that. We believe the slowest recovery is actually going to be in our hospitality sector as business travel will be constrained, and we're planning for that as well. 2 points that I'd like to communicate vis-a-vis Cisco and our financial health. We had roughly 16% market share pre-COVID, which is by far number one in the industry. So we have tremendous headroom to grow in a roughly $300 billion business. So even if that business were slightly smaller in the future, which we don't believe it will be, but if it were, we have tremendous upside potential. And even within the customers that we directly serve today, we have about 30% of their share of wallet. And the strategic initiatives that I was referring to, we believe will increase our penetration with existing customers. And again, we have the opportunity to grow top line profitably in a post-COVID environment.
In an immediate world, can you give me some insight into the protein world? Wendy's on their call right now talking about shifting their marketing focus to chicken because of the beef issues. Sort of where do you see the supply chain? Where do you see the food inflation? Where do you see the problems? Where the deflation?
Yeah, it's a great question. The protein space in particular, is under some strain at this point in time. What I would say is, we're open for business though across all lines of business, and we have access to product. We have redundancy in suppliers. We have strong business relationships with those suppliers, and we've not had specific or significant source of supply challenges. There have been reports in the industry. Wendy's, as you just described, Tyson as well, has gone pretty public about some challenges. What I would submit is that the challenges will be time-based and they will be specific product category based. There will be plenty of protein to be purchased in the grocery channel. There'll be plenty of protein to be purchased away from the home. There very well might be specific cuts of meat or specific product categories that for a short period of time have some supply challenges. But I'm confident that our manufacturing partners are operating in a safe manner. They're taking the precautions to protect their workforce, and they can ramp up their capacity pretty quickly. So I would say the challenges that we're seeing are going to be short duration and won't be endemic for the industry.
Final question for you, and we just have about a minute left, but what kind of restaurant am I going to be eating in 2 years?
That's a great question. What is clear is what's happening right now is that the fast food restaurants that have drive-thrus are performing much better than other type of restaurants. And that makes perfect sense, right? You can just pull up to the window, get your food and go. Those chains are doing quite well in comparison to the others. The hardest hit restaurant has been that locally owned small restaurant in your community. And we are working harder than ever before at Cisco to help those companies be successful. We've taught them how to apply for a CARES Act, keep their head above water financially. We're actually doing a campaign right now called #TakeOutToGiveBack to help support those local restaurants. Our hope is that the majority of them will be successful. I do think we'll see an increase in bankruptcies. There'll be a smaller number of independently owned small restaurants over a period of time, maybe a year to 18 months. What I would submit though is for the long term, there will be many of those people who get back into business, perhaps as a new restaurant in a new location, because people want to eat at that local restaurant. The trend pre-COVID was locally sourced, farm to table, someone that actually who owns the restaurant. And I do think for the long term, we're going to get back to equilibrium pre-COVID.
That was Cisco CEO Kevin Huracan talking to our very own Alex Steele about his specific business. Let's talk a little more broad about the U.S. economy now. We bring in our colleague now, Michael McKee. He is Chief International Economics and Policy Correspondent for Bloomberg. So Michael, one of the things that has really struck me is how much money the U.S. government is going to have to borrow. And it seems it's gotten the bond market's attention as well.
It definitely has, David. The big deficits that we have coming up, they've got to be funded somehow, and the Treasury is announcing today its plans to do that. They're going to borrow $3 trillion. That is an enormous amount, magnitudes higher than anything that has ever been seen before. It's a little bit like the chart that you see for jobless claims there, that yellow line all the way over on the right. That's what they announced today. The white lines are what they've done in the past. In the first quarter, they borrowed $389 billion. This quarter, they thought they were going to have a net redemption of $56 billion. That's not happening. So what are they going to do? Well, next week they start with an auction of $96 billion. 37 of that will be just for cash, to have a cash cushion in case they need it. And then what they're going to do is over the next 2 months, raise the amounts that they sell in each of the tenors, the 3s, 5s, 7s, 10s, and 30s. They're also going to start introducing a 20-year bond, first time. And someone at the debt management agency has a sense of humor, David. They're going to sell a 20-year bond for $20 billion on May 20th of 2020. It's obviously some sort of inside joke for the bond market.
Yeah, what I want to know, a bit facetiously, is President Trump going to sign those $20 billion 20-year bonds? So, Michael, at the same time, that's representing what the government's already appropriated. We now have Congress talking about a new level. Can we keep this up? I mean, we had now Jim Bullard, as you know, and talked to him several times, the president of the St. Louis Fed today, saying we can't keep the economy shut that much longer or we're really going to face a serious depression. Yeah,
Jim Bullard this morning speaking on CNBC was saying that we could go, if we don't start growing again in the third and fourth quarters, we could go from a Great Recession to a Great Depression. And his argument is that's just as bad for the health outcomes of the nation as just keeping, as the COVID disease has been and keeping the economy closed. So there has to be some sort of way of safely splitting the middle, getting the economy going without risking too many lives. And that's pretty much what you're going to see from most people who look out and see what's happening in the economy. We're forecast on Friday to report 21 million people unemployed. That's just an astounding number. I keep saying astounding, but they just are astounding. And unemployment anywhere from 17 to 21%. So there has to be something you can do. What we haven't seen yet is states that have got a good plan necessarily for doing it without causing a lot more death. That's what everybody's looking for.
At the same time, Mike, does this give at least some support to President Trump, as he said, we have to let the states decide for themselves when they come in and sort of let 1,000 flowers bloom, Pache Mao Zedong, but let 1,000 flowers bloom here, let a lot of different experiments happen the way you do in a federal system, and that may be a way of easing our way back into an active economy.
Well, the president's right. We have to reopen. The only question is timing and how you do it safely. And there are disagreements. Some feel that there should be sort of a national standard and national guiding hand, especially to try to get enough tests to the states so that they can make sure people are safe. And others say, let the states do it. We'll see what happens. The interesting thing is apparently none of the states that are reopening yet meet the president's own guidelines for doing it. But there is a lot of impatience out there to get going.
Well, there sure is, no doubt about it. Thank you so much to Mike McKee, the ever stalwart correspondent for Bloomberg News. Thanks for being here. At the same time, coming up next, we're going to talk about whether the tech industry can help save us from the coronavirus. We talk with the Chief Strategy Officer of DomeOne. That's coming up next on Balance of Power on Bloomberg Television and on radio. Welcome back to Balance of Power on Bloomberg Television and on radio. I'm David Weston. Well, states and federal government as well are desperately trying to get their arms around the data surrounding the coronavirus. And there's a lot of data out there, but how can they understand it? Well, there's one company that's helping at least some states do that. It's DomeOne. We're joined now by its Chief Strategy Officer. He is Mr. John Malore. So John, thanks for being with us. First of all, give us a sense of what you have. I must say I've seen it, as I just said to you. I went on your site and I realized I've been looking at it for some time. You've got some maps and some charts that are very instructive on coronavirus.
Well, thank you, David. I appreciate the opportunity. Domo is a company really grounded in data. So really our business is about helping companies leverage the data and the systems that they've got, do that at massive scale, and do it at an incredible amount of speed. So probably what you've seen is the coronavirus tracker that has been on our Domo.com website that gives you very detailed information at a macro level of how the virus is spreading throughout the world, but then also lets you dive deep down into states and counties, countries, et cetera. It's very interesting data and has been a good sort of way for Domo to explain what it does to the world.
So you're working with at least 3 states that I'm aware of. Who are you working with, and what are you doing for them?
So we've been working with the state of Utah, the state of Iowa, and the state of Nebraska. And if you think about the challenges that these states are faced with, it's really this balance of how do I manage public safety, and this is first and foremost a medical issue. But how do I balance that with the economic realities of opening up the states or closing them down at the appropriate times in order to make sure that my economy functions correctly? And what we allow them to do is we've built a crisis command center that allows these states, particularly the governors and their executive offices, to bring together the relevant information in their states so that they can be informed about what's happening. A lot of the discussion has centered around models and forecasts and what's going to happen in 30, 60, 90 days. But the states are faced with issues that have to be dealt with today. Like, what are the transmission rates? What is my hospital capacity? Where are exposures happening now? And this is information that requires lots of different data sources from legacy systems that weren't really built to talk to each other and certainly weren't built to do it in real time at the kind of scale that needs to be done. And then once you get this data together, how do you distribute it out to the relevant parts of the executive team, these incident management teams, so that they can make day-to-day, hour-to-hour decisions on what to do to balance this public safety with opening up the state and keeping the economies working?
So John, data visualization is a big subject these days. A lot of people are trying to do it or are doing it. Give us a sense about what your comparative advantage is at Domo. Why are you better than the next guy? Is it the amount of data? Is it how fast you process it? Is the visualization? What do you do better?
Sure, it's really 3 things, David. I mean, visualization is sort of the cherry on top, and in a way that is not the secret sauce that Domo relies on, although we excel in our usability and visualization. But the key parts of being able to inform a business so that they can make decisions and drive modern processes is threefold. First is you have to be able to get the data together. It's about data integration, that first mile. And that comes through how do I leverage all these investments that I've already made in legacy systems? I mean, those aren't going away. The systems in governments, the Epitrax systems, the old legacy, Oracle databases, those are there to stay. And you can't rip those out. You just have to go in and leverage those. And we've got 1,000 pre-built connectors that allow you to do that in very, very short order. I mean, for the state of Utah, we had them up and running on a Tuesday, and our first conversation was the previous Thursday. So that ability to connect the data at really fast speeds is what gives you the first mile secret sauce. Then, of course, once you've got the data, you can do pre-visualizations. But then the last mile, what's really interesting are these intelligent business apps. So, for example, we've built a governor's app that allows the governors in Iowa, Nebraska, and Utah all to bring together the data that is most important to them in their state based on kind of what are the hot topic items for them. So the governor can get real-time alerts about what's happening with transmission rates in certain counties. When do things meet a certain threshold? When do, a certain number of infections happen? When is there a fatality, et cetera? So that way these governors are are using the Governor app to really kind of dial in the information to exactly what they need. And they're doing it right on their phone, right on their mobile device. So it's not like you have to sit down to a computer and log in and, check the information that way. It's right in your pocket. And so you got the three things. You have data integration, that back-end leverage of your systems, the visualization and analysis of data, but then being able to build these intelligent business apps. That's really where this is going.
Well, John, one thing is for sure, we've never needed it more. So congratulations. It's got to be more valuable what you're doing now than it has been in the past. That's the Chief Strategy Officer for Domo. He is John Mellon. So coming up next, we talk with the CFO of General Motors. They have their earnings out and did better than people thought. That's coming up next. Divya Sariadevara on Balance of Power on Bloomberg Television and on radio. Welcome back to Balance of Power on Bloomberg Television and radio. I'm David Weston. GM announced its first quarter earnings today, surprising many on the upside, driven largely by pickup truck sales, up about 27%. I talked to the GM Chief Financial Officer, she's Divya Sariadevara, and I asked her about the critical question of when they can get their plants back up and running and whether they can replenish the inventories of those precious pickups.
Yeah, inventories are something that we're watching. We are well positioned on most car lines, and as you know, we came out of the strike in later part of last year, and we have had leaner inventories, and it's frankly it's going to be helpful in a scenario where SAAR ramps up slowly. Looking at it, and from a pickup perspective, we do find ourselves in a situation where we have lower inventories. But the good news is the dealers have gotten very experienced in managing through the constraints that they're seeing in the product and how to dig deep into inventory and still maintain sales. So that's the good news. And as we think about the plants returning to work that we're targeting May 18th, that should help us address the shortfall from an inventory standpoint.
GM announced its first quarter earnings today. It also announced that it took down some money from some revolving credit lines, something like $3 billion in the automotive, another $2 billion in GM Financial. That's after already amassing something like $33 billion in automotive liquidity. As you look forward, Divya, what tells you you're going to need that extra money?
So if you think about our liquidity, we've always, in the last several years, said we want to run a very strong investment-grade balance sheet. And that's actually come in handy during these kinds of times. And as you quoted, we did end the first quarter with a very strong liquidity position of $33.4 billion. And David, it's difficult to anticipate what's going to happen, but we are taking steps to protect ourselves, whether it's austerity or, like you mentioned, revolver and suspending dividends and share repurchases as I would say, precautionary measures to make sure we have additional layers of liquidity. We are comfortable with our liquidity position now that will take us well into Q4, even in a scenario which is pretty onerous of like zero production. And obviously, as we talked about the restart, when we have a restart, our liquidity levels will recover from here. So I would say these actions are precautionary and proactive actions to make sure we have additional liquidity buffers in place. So what we're focused on now is to safely restart the plants and get the production up and running.
So this pandemic comes along at a time when the auto industry and General Motors were going through a transformation, a fundamental one, to autonomous and electric vehicles. You've been investing quite a bit in both of those. Are you changing your investment plan on that? Do you have to put that to the side while you deal with the after effects of the pandemic?
Absolutely not. We are marching ahead in our plans with EVs and AVs. We're committed to an all-electric future, and all the plans that we've outlined recently in our Capital Markets Day, as well as our EV Day, with respect to the products, the exciting products that are going to be rolling out, we see little to no impact on any of these. The capital actions we're taking and the austerity actions will not impact the programs that that you just outlined. So we're fully committed to that. And frankly, the balance sheet that we've been maintaining and the financial flexibility we have allows us to continue these investments as we go forward, even in these challenging times.
Divya, you raised one last issue, which is the pace of the introduction of new vehicles. Put aside EVs and AVs, just in general. That's one thing that's been a hallmark of CEO Mary Barra while she's been there, having an increased pace of new vehicles. Is that going to slow down?
We are committed to putting products that our customers are very excited about, and you can see the success that we've had recently, even with our trucks, and that's not going to change. And we do put the customer in the center of everything we do, and you will see that continue in the product cadence that comes along here.
That was General Motors Chief Financial Officer Divya Sariadavar, with whom I had the pleasure to speak earlier today. That does it for TV on Bounce Bar today, but we'll continue on radio. We're going to be joined by Jan Brewer, the former governor of Arizona, about opening her state back up, and also Nobel laureate Paul Romer on his plan to open things up with an extensive testing system. I'm David Weston, and this is Bloomberg.